Good morning, traders. Creed Moore with Traderverse coming to you here with your market breakdown. We've had an interesting last couple of days. The U.S. just conducted a military operation that captured Venezuela's president. The stock market barely moved. Oil prices have fallen slightly over the last couple of days with a nice little jump here in the early morning session. We do want to make sure we're keeping a close eye on the CL and USO. Now, I'm going to show you exactly what's priced in and what isn't so you can position ahead of the real moves that we're expecting. Here in the early part of January, the Trump administration executed Operation Absolute Resolve, a direct military strike on Venezuela's capital. The result, Nicolas Maduro and his wife, Ms. Flores, in federal custody, facing drug trafficking and narco-terrorism charges in Manhattan. This is unprecedented, direct military intervention capturing a sitting president, and here's the paradox that's going to make you some money. Crude oil fallen from those early prices of the higher 58s, dropping down into this 57 region, creating a double bottom, a triple bottom if you're looking at the back section here, and starting to rise up in a classic W pattern here, looking at this prior swing high. Now, you'd expect chaos in an oil producing nation to spike prices. Instead, oil is really maintained a level head. Why? Because the traders who actually move markets understand something that most people just don't. Venezuela produces 1.1 million barrels per day, roughly. That sounds like a lot until you understand in context. It's less than 1% of the global supply. If you want to find more info on that, check out OPEC. But here's what actually moves oil prices. It's not production today. It's production tomorrow and in the future. Venezuela has the largest proven oil reserves, 303 billion barrels from what we've seen so far. Under Maduro, production collapsed from 3 million barrels a day down to 1.1 due to mismanagement and international sanctions. But a U.S.-friendly government changes that equation completely. I'm expecting within 18 months, Venezuela could realistically double, if not triple, its production capacity. That means potentially adding 1 to 2 million additional barrels per day to the global markets and filling the U.S. SPR for a strategical move, thus us buying less oil from other nations. And here's a critical insight that explains why oil is level-headed / falling instead of spiking crazily. Global oil markets are currently sustaining their supply. That's what traders call a super glut. Right now we have more crude than we're really taking in. So we got more supply than we have demand, thus adjusting prices. Adding another 1 to 2 million barrels additionally from the Venezuelan supply per day into an already oversupplied market doesn't help prices. It crushes them. This is why they tailor those pricings to come in and out of the market specifically. So traders are already pricing in the probable outcome with regime stability, confirmed production recovery begins, and oil tests this lower 56 area for support and possibly even going lower as that production ramps up. This is why oil is maintaining more of a level head than spiking in either direction. Now, here's the exact setup that I'm watching. Looking here at the hourly time frame, you can see we have a beautiful high here. We have good strategic lows here. Okay, those lows are right at the 55 area. We have a nice ascension in price. This is when all of our interesting capturing volume has taken place. I'm keeping a very, very close eye on two strategic points. This prior high right here and this prior low. Now for the astute ones, you'll notice, what do we have? Descending channel, okay? The operative thing you want to look for is our central node. Your central node right here at about the 5770 area, you can see when we zoom in, has been an oscillation point for price. You want to keep a close eye on that price action, and the way that I'm structuring my trade is if we break above this 50-70-70 with conviction, I'm going to be targeting these highs at 58.50 and 58.85. I'm not looking for 59, I'm not looking for 60. That is to come into the later weeks once we see more establishment of the regime change, and once we start to see more production come onto market, we may even see a rejection of this high and falling back into the megaphone here. Now, with that being said, you always want to make sure to hedge your risk on what we're seeing in the markets. Well, how can you do that? Now, there's an important hedge to this thesis. If things go wrong in Venezuela, if civil conflict erupts, if regional instability spreads, if Trump signals border military engagement in Latin America, then the opposite happens. We'll see safe haven assets like gold jump even higher, and I would expect silver to jump as well because of the fear of global war to come in. Remember, when you're dealing in these larger style assets, gold, silver, oil, those are affected by geopolitical endeavors. And with the relationships that we have in place, if one country is brought into war, then another country is brought into war because they have to honor the partnerships that they have with those regions. This creates geopolitical instability, but it also creates an environment for the typical consumer and the corporation, a necessity to hedge their longer term portfolios. They go to safe haven assets such as gold, silver, and other products not around oil, since that would be the specific product that the conflict is over. So we want to make sure that we're keeping a close eye on those specific commodities that reflect off of that oil, and the companies that can be affected both in a benefit and a deficit from a conflict going on due to this. Companies you may want to keep an eye on are companies like U.S. Oil. You may also want to keep an eye on Taser, Smith & Wesson. You want to keep an eye on aeronautics companies like Boeing. You may want to keep an eye on shippers as well. These are all different companies, environments that are going to be impacted by this global maneuver. Now, if you want a pure upside opportunity with low risk, here's the play that actually benefits from stability. CVX, Chevron. Let me give you a look real quick. CVX. Now, looking at CVX, you can see after everything that's occurred through here, yes, we did have some initial news movements here. CVX getting a big push here. You also want to keep an eye on Shell and your other refined fuel product distributors. It's the only major U.S. oil company currently operating in Venezuela. Right now, they're producing around 120,000 barrels per day under a treasury license. A pro-U.S. government, Chevron immediately gets optionality to expand operations because they're already in the region. They can accelerate production recovery and potentially take a majority control of the assets. That's a $10 plus movement in the stock. And you can see here our gap up, 155 all the way to 168. Come on. Any stabilization announcement from the Trump administration, business is continuing. Operations are secure. CVX can operate freely. Chevron is likely to rally 5, 10, 15% as funds flow into their operations to help expand it from your larger private equity, your larger corporations, and your pension funds. The probable event is the Trump administration announcement confirming CVX operational continuity and sanctions relief, which is going to completely affect their bottom line. The macro perspective, here's the contrarian idea. When they see military intervention in a Latin American country, they immediately think emerging market weakness, flight to safety, de-risking. And yeah, emerging market ETFs like EEM saw some initial pressure, but here's the thing. The operations might actually reduce long-term geopolitical risk premium for Latin America. If the U.S. is credibly establishing a stable governance in a failed state, that's actually bullish for regional stability. Colombia, Mexico, Brazil all benefit from knowing there's a credible backing and backstop against chaos. Similar, and if you remember, when the U.S. took over the Panama Canal, we now have oil production, a free trade route through there with control. So here's your playbook. Scenario 1, stability confirmed, oil breaks those highs, Chevron rallies, emerging markets bounce, your long CVX, short USO. Scenario 2, so conflict emerges, gold breaks out, oil rallies because of the conflict, everything's risk off, you exit those shorts and look to take positions in longer assets like gold, silver, etc. Scenario 3, choppiness, uncertainty. Choppy consolidation, while the market wants and waits for clarity, this is the base case right now. Watch for the probable events that we've discussed. The traders who position now ahead of the probable event confirmation are the ones who see the biggest moves, but they also take the biggest risks. Comment down below which scenario you're positioned for, and if you want deeper research on this trade and others, I have a detailed analysis linked in the description, and join me on Traderverse to see all the market updates that I'm posting on the hour, not just this conflict, but other things going around the world, and the trades that I'm looking to take in my portfolio. As always, this is Creedmoor with Traderverse, and your trades are in the history. I'll see you around.